So the dollar, Trump last time around, same thing. The markets priced in tariffs. The dollar screamed higher. It created this weak patch of growth. Trump came out and said the dollar's too high. Guess what? Scott Bessent, who's a macro hedge fund manager, I've known him for 20 years, 25 years. He understands the game. Trump said the same thing. Everyone said the same thing. The dollar's too strong. And hey presto, the dollar has utterly collapsed. So it's a very powerful setup. A weak dollar is incredibly good for world growth. It allows China, everybody else to start exporting. The whole world economy starts picking up. The last time this happened, the Trump cycle, well, that was the initial correction that we got. We had this whole period of correction, much like we've had now. It stopped in about March. Well, we got to about April. And then we did this. And from that correction low, it did a 23x. Now, I don't expect Bitcoin to do a 23x.
The US dollar is starting to weaken. And if this mirrors the last cycle, Bitcoin could once again lead a rally similar to the 23x move we saw before. That's the latest message from Real Vision CEO Raoul Pal. Bitcoin has spent recent weeks caught in a whirlwind of market chaos, driven less by crypto itself and more by global economic issues. Traders are grappling with rumors about shifting interest rates, dramatic swings in Bitcoin ETF investments, and growing global tensions fueling uncertainty. For many, it feels like the market is stuck in limbo, caught between the fading heat of a bull run and the early chill of another crypto winter. One of the main accelerants behind the price swings is institutional behavior around spot Bitcoin ETFs. As money flows in, momentum builds, pushing prices higher. When capital pulls back, the market stumbles. This pattern has been further complicated by fresh regulatory pressure from the US and Europe, which has made investors more cautious. Meanwhile, conflicts and political instability across regions have investors questioning which assets can truly offer stability. This uncertainty has pushed Bitcoin into a kind of identity crisis. Is it still a speculative bet driven by hype cycles, or is it slowly transforming into a digital counterpart to gold? Market action over the past month suggests it's trying to do both. Volatility still rules the short term, but the longer view may offer more clarity. Macro analyst Raoul Pal believes these current conditions could trigger a major Bitcoin rally. Drawing on years of data linking liquidity cycles, central bank rate decisions, and asset performance, Pal argues that Bitcoin's current price action fits into a predictable pattern seen in previous cycles. With the Federal Reserve expected to adjust its policy and global liquidity starting to shift, Pal sees potential for a strong upward phase rather than a prolonged decline. Make sure to stick around until the end of the video as Raoul Pal explains how the same conditions that triggered a 23x rally are showing up again. Also guys, only a small percentage of my viewers subscribe. If you enjoy staying updated with finance content, consider subscribing or liking the video. It's free and you can always change your mind. Now, here's Raoul Pal with his latest market outlook.
Firstly, I use a framework that I call the Everything Code. It's something that I've spent 35 years building in macro, where I started to realize that the dominant factor in all of macro is actually liquidity and the debasement of currencies, and it explains most price movements in all of the assets that we care about. And I realized it's all to do with debt, and it came from why we're seeing 4-year cycles in crypto and the economy and all of these things is actually driven by the debt refi cycle. The world just reached too much debt back in 2008, and what we've been doing since then is servicing the debt. We've also got some other key factors. This chart is a chart that I produced a few years ago. It's still the single most important chart in macro and explains everything that is going on in our world today. And this is the fact that demographics is everything, and the demographics of the aging populations across the Western world, these are the US numbers using the labor force participation rate, explain the build-up in debt. Why that is as populations get older, economies slow down. To service the existing debt, it requires more debt. To create GDP growth, you need more debt. See, GDP growth is driven by population growth, productivity growth, and debt growth. And debt growth has been the driver both in the US, in China, in Europe, in the UK, all across the world. It's all driven by the same dynamic, and that's this aging population thing. It slows down GDP growth and creates unstable economies. And that chart just shows the stunning correlation between debt to GDP and population itself. What's interesting is then when you go one stage further and say, okay, we're seeing this debt, how are we dealing with this debt? And it's actually just driven by liquidity. So here I'm using Fed net liquidity. Fed net liquidity is the balance sheet of the Federal Reserve, the Treasury General Account, which is the Treasury themselves, not the Fed, and then the reverse repo facility. These are the levers that they've been using. It started just using the balance sheet, 2009, all the way through to about 2014, it was just the use of the balance sheet. Then they started sneaking in new ways of debasing currency, and that was by adding in these other levers, getting banks to put reserves here or take reserves out there, or injecting money into the economy via the checking account, the Treasury General Account. That's actually shifted to total liquidity now because everyone figures out the game, which is the debasement of currency, debase the currency, try and grow GDP growth and lower debt to GDP or just manage it. Now they're using total liquidity, which includes measures like M2, which is the banking system as well. So when you add those things up, this has, and I'll show you these charts later, the most stunning correlation of all time to all assets. So 90% of Bitcoin's price movements are driven by total liquidity, and 97% of the NASDAQ. So here's the real issue here. Why are the rich getting richer, the poor getting poorer? Well, scarce assets keep going up in price. Real estate, equities, art, gold, all of these things. Young people can't afford it. Poor people can't afford it because they've got variable income, which is earnings, and it buys them less of these every year. What's actually happening, what that mechanism is a tax on everybody of 8% a year. A global taxation of 8% a year that you don't understand. You just don't get richer by 8% a year. Add in another 3% global inflation, you're at 11% debasement of currency. That's your hurdle rate to stay as wealthy as you are today. That's a staggeringly difficult thing, considering most asset classes don't produce those kinds of returns, which is why so many young people have come to crypto, because crypto completely upends this system. They can't buy houses, they can't buy all of the other things that older people were able to afford. So they forced into more speculative, high risk assets that have much higher returns. It's the only way out of the trap. And the trap is driven by this debasement. So if you want to see how close the correlation is, and I'll show the full correlation chart later, it basically drives Bitcoin. And what we see is there's periods where it decouples, and these are the banana zones. It decouples when what we get is the retail frenzy, and the frenzy into the market, cools off, comes back to trend rate of this debasement of 8% or so. But over time, it produces astonishing returns. And that's why Bitcoin looks like this on the log regression channel. It's also still remarkably cheap. Where it ends up at the end of the banana zone is usually the 1 or 2 standard deviation level. We're a long way from that, and that would give us much higher prices. You can't see it on this. But if it were to get to 2 standard deviations, that would put Bitcoin at $850,000. I don't think it's going to go there. But what we're saying is there's plenty of upside to come. I know people get frustrated in sideways markets. It's just the nature of the beast. It does nothing, corrects for a while, and then explodes out of the traps. And we're kind of in that phase now that I'll talk to you about.
Raoul Pal just outlined a clear way to understand not only Bitcoin, but the financial system as a whole. He focuses on liquidity, the flow of capital that pushes markets higher during expansions and keeps them afloat during downturns. Pal explains that this cycle of liquidity is shaped by global debt, aging populations, and a financial system that relies on currency debasement just to function. In this kind of environment, assets with limited supply, like Bitcoin, stand out. For younger generations priced out of homes and traditional investments, Bitcoin is becoming a way to protect themselves against the quiet erosion of purchasing power. Pal estimates most people lose 8 to 11% of their real buying power annually without realizing it. He believes we're not near the end of Bitcoin's current cycle, but somewhere in the middle of a larger buildup. Bitcoin, in his view, moves through long flat periods followed by sharp price surges. Right now, he says we're still below the range where speculative peaks usually occur. That means this slow stretch might not be the end. It could well be the pressure building before the next major move. Now let's go back to Raoul Pal as he continues his analysis.
Crypto is this super massive black hole that simply outperforms and sucks every other asset dry. This is the big one, the biggest one we've ever been given, the greatest macro opportunity of all time. We've got the central banks debasing currency, which is giving us a gigantic tailwind. They don't want the system to break, so every time something happens, they inject more liquidity. So they're giving you free money. And to take that money, you need the volatility. So what causes the volatility? Well, it's actually driven by liquidity again. Once you come to narrower time horizons, liquidity changes things. So we've just gone through a 3-month period of the market feeling shit and everyone's saying it's all over, we're never going to have alt season, everything's terrible, we're all going to die. What was actually happening was the fact that in Q4 2024, financial conditions tightened. And we measure financial conditions by the dollar, rates, interest rates, and oil. All of those went up in Q4, and there's a 3-month lag, and it drives it. So here's a simple way. We're now seeing people saying the economy's slow, shipping's slow, all of the tariff stuff. The market's priced in this tariff stuff last year once they saw the probabilities of a Trump re-election. So what we've got here is the economic surprises index of the US versus other countries in the world. i.e., when it's going down, the US is underperforming in economic surprises term. When it goes up, it outperforms. It's basically just following the dollar and rates. And what it's saying is, whatever noise we're seeing now in the economic data, which is some of the tariffs-related stuff, as people have built inventories very quickly, liquidity is going to completely erase that very quickly. We saw it exactly in 2017 when Trump imposed similar tariffs, similar backdrop. The dollar and rates fell. And what we saw back then was the same collapse in the economic surprises index. We had talks about recession all over again back then. Trump's going to create a recession. Then what happened was the liquidity conditions drove all economic data higher. And when we look at that economic data, Bitcoin's already priced it in. It's already priced in, weaker than the economic data itself. So what are we fearing right now? What are people worried about? People are worried about what they're doing is creating narratives for today to explain liquidity conditions from 3 months ago. That's the ridiculousness of what goes on Twitter all day. It is a lack of understanding of what actually drives these markets. What are the dominant factors? The dominant factor is financial conditions, which lead liquidity, which lead markets. And even in markets, it's gold actually follows financial conditions the closest. Then with a lag, it becomes crypto and tech. Then with a lag, becomes the S&P 500, cyclicals, commodities, all of those things. So people are talking about recession now. We've had this negative GDP print. A lot of this is technically driven by the imports that are happening to load up on inventories as tariffs come, so people don't have the price shock. Okay, fine. So most of this is going to get unwound. Why? Because global growth is about to pick up super fast. So the Philly Fed, this whole presentation was put together a week and a half ago to send here, so it's all out of date. So the Philly Fed latest numbers came in exactly as predicted by us, by this chart. It's actually quite useful because I just went through this deck this morning and all of this was from 2 weeks ago and it's all proven to work. So Philly Fed comes down now. So what we should see is now an increase in economic activity going forwards. So i.e. the back end of the year is going to look very different than the first quarter did. I use a lot of technical analysis. I even do it on economic data, which is abhorrent to most people, but it's worked for me for 35 years. And I use, this is a system called DMARC indicators. And basically it's telling you that we should see the economic surprises starting to rise. Bitcoin is led by financial conditions here by 3 months. The year-on-year rate of change of Bitcoin, we should start to see very dramatic movements in the price of Bitcoin going forwards. And I'll show you a bit more about this in a sec. So the dollar, Trump last time around, same thing. The market's priced in tariffs. The dollar screamed higher. It created this weak patch of growth. Trump came out and said the dollar's too high. Guess what? Scott Bessent, who's a macro hedge fund manager, I've known him for 20 years, 25 years. He understands the game. Trump said the same thing. Everyone said the same thing. The dollar's too strong. And hey presto, the dollar has utterly collapsed. And we haven't started yet. And it's a cyclical thing. It's not the end of the dollar. That's another narrative you read. There can't be the end of the dollar right now because 87% of world trade is in dollars and 50% of the entire world's debt are in dollars. So that's 200% of global GDP is actually in dollars. So there's a shortage of dollars globally, and that won't go away for a long time. So the dollar's collapsing. This kind of thing is a massive tailwind. As the dollar weakens, it means that the more global exports pick up. Everybody who's a foreigner who services US government debt, it's cheaper to service the debt, costs them less of their domestic currency cash flows. So it's a very powerful setup. A weak dollar is incredibly good for world growth. It allows China, everybody else to start exporting. The whole world economy starts picking up. The last time this happened, the Trump cycle, well, that was the initial correction that we got. We had this whole period of correction, much like we've had now. It stopped in about March. Well, we got to about April. And then we did this. And from that correction low, it did a 23x. Now, I don't expect Bitcoin to do a 23x because this was much earlier in its adoption curve, but some of the others will, something close to it. We've got a perfect setup, one of the best setups I've ever seen, because we know the debt has to be rolled, we know the forward-looking liquidity is coming, and we know how assets react to it. Just like having a crystal ball. Nothing will be perfect, but directionally, it should be right.
As Raoul Pal explains, financial conditions directly affect asset prices. Bitcoin is no exception. Historically, when liquidity tightens, markets tend to cool down. But when financial conditions ease, often in response to economic stress, asset prices typically rebound. Bitcoin has responded sharply to these shifts in recent years. A major factor in this cycle is the growing weight of global debt. As governments manage their debt burdens, central banks expand balance sheets to stabilize economies. These actions inject liquidity that supports a wide range of assets, from real estate and stocks to more speculative ones like Bitcoin. While today's financial environment has its own set of challenges, the core drivers behind market behavior are still the same. As the dollar shows signs of weakening and liquidity picks up again, conditions are becoming more favorable for assets that benefit from those trends. Bitcoin, in particular, may face renewed upward pressure if these conditions continue. Given Bitcoin's growing market maturity, the size of any future move may not mirror past cycles, but certainly the direction could still be very meaningful. Anyway guys, before we go, if you want to stay most up to date on the crypto and Bitcoin world, subscribe to my daily 5-minute crypto newsletter. It's a concise resource for the latest expert predictions, breaking news, and top on-chain analysis, trusted by over 50,000 subscribers for insightful crypto investment information. Don't miss out on the opportunity to stay informed in the crypto market. The link is in the description below. I hope you all enjoyed today's video and that it gave you some value. I'll see you all at the next one, and as always, all the best.